All right, let's talk about the absolute heart of any automated trading system, teaching it how to manage risk. Because let's be real, a trading bot that doesn't understand risk isn't a strategy, it's just a slot machine. So let's get into how we can build a smarter one.
So I want to start with a really important question. Just forget about fancy indicators or predicting the next big market move for a second. What is the single biggest reason, the #1 killer of trading accounts? Doesn't matter if it's a person or a robot at the controls.
And there you have it, poor risk management. See, it's not about being wrong. We're all wrong sometimes. It's about being wrong too big. You could have the most brilliant trading idea in the world, but if the risk management is terrible, it's just doomed to fail. So today, we're going to build the solution piece by piece.
And that solution begins with what I like to call the golden rule of trading survival. You have to master your position size. This isn't just some friendly advice. It is the fundamental lever you pull to control just how much skin you have in the game.
This quote from TO Markets really just hits the nail on the head, doesn't it? Your lot size isn't some random number you type in. It's the dial that controls your financial exposure. If you get this right, you can weather the inevitable storms of the market. But if you get it wrong, well, one bad trade can be game over.
Okay, so if we're going to control it, we have to understand it. Let's break down what we're actually talking about when we use the word lot in Forex trading.
You know, at its core, a lot is just a standard unit of measurement. That's all it is. It's how we all agree to talk about the size of a trade. Kind of like how you buy eggs by the dozen, not by the single egg. It's just the standard quantity everyone uses.
Now, check out how this table turns those abstract units into cold, hard cash. A standard lot, which is a volume of 1.0 in your trading platform, is controlling 100,000 units of currency. So for every tiny price move, every pip, that's about a $10 swing. Now drop down to a mini lot, and that exact same price move is suddenly only worth $1. Go even smaller with a micro lot, and now it's just 10 cents. You see, you are literally choosing your risk level right here.
And that brings us right to pip value. It's the simple answer to the question, okay, so how much is each little market tick actually worth to me? And as we just saw, that value is a direct result of the lot size you chose.
Right? So we know what a lot is and how it dials our risk up or down. But how do we figure out the perfect lot size for any given trade? Let's dive into the formula that turns our risk in dollars into a precise trade size.
This right here is the million-dollar question every single trader and every trading robot has to answer. How do you make absolutely sure you never lose more than you're comfortable with on one trade, no matter where your stop loss happens to be?
And this is the recipe. It's a beautiful 4-step process. First, you decide your max risk in dollars. Let's say it's $100. Next, you figure out your stop loss in pips from your chart, say 50 pips. Then you just do some simple division. $100 divided by 50 pips equals 2, so you need each pip to be worth $2. And finally, you convert that to a lot size. We saw a 0.10 lot is about $1 a pip, so to get $2 a pip, we just need double that, a 0.20 lot size. See? Simple as that.
Now, a quick word on that first step, defining your risk. A really common rule of thumb, and it's a good one, is to only risk a tiny percentage of your whole account on any one trade. We're talking something in the ballpark of 1 to 3%. That's how you stay in the game for the long haul.
Okay, we've got the theory down cold. Now for the really fun part. How do we take that 4-step recipe and bake it right into our MQL5 code so our little trading robot does it perfectly every single time?
I mean, when you see it side by side like this, the case for automation is a slam dunk. On the left, you've got manual calculations. They're slow, and worse, they're vulnerable to emotion and fat finger errors. But on the right, the robot's way is instant, it's 100% rule-based, and it is precise down to the last decimal every time. That's the kind of discipline we're programming for.
So how do we pull this off? Well, the good news is we don't have to start from square one. MQL5 comes with these amazing things called the standard libraries. Honestly, the best way to think of them is like a pre-built toolkit for developers, full of ready-to-go solutions for all the common stuff.
And this quote really gets to the heart of why they exist. The folks who created MQL5 already solved a lot of the basic problems for us. By using these libraries, we get to focus our brainpower on the fun stuff, you know, the actual trading strategy, instead of reinventing the wheel every time.
Now, even after our bot calculates that perfect lot size, there is one last absolutely critical step:
It has to do a final safety check to make sure the trade is even possible without getting us in trouble with the broker's margin rules. Think of it as the final guardian at the gate.
So how does it do that? How can a piece of code know for sure that placing a trade won't put the account in a dangerous spot? Well, it does it by basically asking the trading platform for permission, using a couple of very specific tools. The first tool in a box is something called the CAccount Info class. The easiest way to picture this is as a digital dashboard for your trading account, but one that your code can read. It's got all the vital stats, your balance, your equity, and most importantly, your free margin. And inside that class is the real star of the show, the free margin check function. This thing is so cool. It's not just reading data, it's actually running a simulation. It lets our code ask a hypothetical question. Hey platform, if I were to open this exact trade right now, would I still have enough cushion and a free margin to be safe? It's literally a pre-flight check for your money.
So to run that pre-flight check, our bot just needs to file the flight plan. It tells the function which currency pair, is it a buy or a sell, what's that lot size we just calculated, and at what price. It feeds those 4 things in, and the platform gives back a simple final answer. Go or no go.
And that's how it all comes together. The lot size formula tells the robot what it should do to respect our personal risk rules, and then the free margin check function makes sure that what it's about to do is actually allowed and safe. You combine those two, and that's the foundation of a seriously robust automated risk system.
So, we've done it. We've given our robot a deep mathematical understanding of risk. It now knows exactly how much to put on the line for any given trade. But that leaves us with another equally important question. How does it know when to risk it? Well, that's where strategy comes in, and that's a topic for another time. Thanks for listening.